Thanks. I'm Pierre Martinow, and I'm very pleased to welcome Constantine Tsavliris, Head of Research at CryptoCompare, to review their latest exchange review. Good to have you here, Constantine.
Thank you for having me.
It's a pleasure. Constantine, your team has been publishing a monthly exchange review for the last couple of years or so. Can you start by telling us how and why the report came about and why you saw the need for it?
Yeah, so 2 years ago, there was no reliable and consistent source of market intelligence centered upon exchanges. And this monthly report filled an obvious gap for that. The report aims to capture some of the key developments within the cryptocurrency exchange market. And it does so by focusing on analyses that relate to volume. So what we do is we'll separate spot versus derivatives, high risk exchanges versus low risk exchanges, and things like that. And we also provide an overview of some of the latest exchange news that occurred over the month. So users are free to click on the links provided if that's of interest to them. So it provides a good all-round overview of where the market's gone and where it's been as well.
So let's talk a little bit about the methodology and the benchmarks you guys use for this report. Can you give us a little bit more color on that?
Yeah, so the benchmark was created mid-2018 in response to a lot of the news about fake volume that was going on exchanges. There were several reports that try to distinguish fake volume from legitimate volume. Our approach was that we would try to separate the lower risk exchanges and the higher risk exchanges based on a transparent methodology. It's a rigorous methodology that kind of looks at various categories of analysis. So we'll have a regulatory standing category, we'll have a data provision category, one looking at security. We look at KYC transaction monitoring. We'll also look at negative events if those have occurred. And finally, we look at market quality. We use a combination of trade and order book data to measure that for some of the exchange's major markets. It aims to look at things like liquidity, spread, depth, and similar metrics. And we take all of these categories and we assign scores to them to come up with a kind of a rigorous final score from, AA being the best and F being the worst.
Interesting. So a set of very granular metrics is there. Very interesting. All right. So looking at the regular standing, some regions have specific licensing and registration requirements, whilst others don't. So if an exchange operates in a region that doesn't have specific regulation for crypto exchanges, do you take the standard of their operational processes into consideration anyway?
Yes, we do. For many jurisdictions that do require a license, there are certain requirements under that. So a few of these might include trade monitoring, transaction monitoring, or more stringent KYC processes, and that's something we measure in the benchmark. So we do include that.
Interesting. Then how many venues are voluntarily implementing such as market surveillance tools, for example?
Based on the latest benchmark, our figures stand at around 50% of exchanges implementing internal market surveillance procedures. So they'll have their internal methodology to flag strange trades. But we also take into account exchanges that use an external service provider. So at the moment, we have the figures at around 5 or 6%. We actually award more points to exchanges that have an external market surveillance provider, because we feel that there's less conflict of interest to adjust any of the findings.
Oh yeah, that makes definitely sense. Okay, let's have a look at your presentation or at the report in greater detail. What were exchange traded volumes like for October?
In October overall, we actually saw an almost 18% decrease in volumes. And that goes for both top tier exchanges and lower tier exchanges.
Then we saw quite a pickup in volatility in the second half of October, something that would typically equate to higher volumes, but the numbers are down on the spot markets, at least from September. What do you think that might be?
Yeah, it might seem like a bit of a paradox given that we've seen quite a significant bull run for the most of October. But if we look at September, in fact, we did see quite a lot of volatility when the price dropped from 12K to 10K. In fact, in general, there was more volatility in September than October. So that's one reason for the drop in volumes. Another reason is we've seen very little price reversal throughout the month of October, which means, again, fewer trading volumes throughout the month. More price reversal means more volatility, which means more trading. And finally, another reason might be that we've seen a decrease in interest in DeFi from September to October. Some tokens, for example, Yearn Finance, have dropped in value from 45K mid-September to 15K mid-September. So that's quite a significant drop. And it might explain, again, some of the drop in volume.
I remember that was quite painful because everyone was hoping it might go up a little further. How are things compared on the derivatives markets versus spot markets in terms of volumes?
This month, spot market volumes did decline almost 18%, but so did derivatives volumes. They declined to a lesser extent by 2.4% this particular month. That means that now derivatives volume actually accounts for around 52% of total market volume, whereas in the previous month, we saw that derivatives accounted for around 48%. And, if you look at a year ago, derivatives accounted for, just under 40% of total volumes. So then they've been making some ground.
So how could you, from your perspective, explain that quite significant increase in derivatives volume compared to last year?
Well, it can be, a couple of different things. The first is new markets, new players entering the market. So one obvious example is Binance. A year ago, they accounted for very little volume. Now they are the leading exchange, followed by Huobi and OKX. Another reason is that there's more variety in the types of products that are available. So you have futures, swaps, and options available on several exchanges now. That wasn't the case a year ago, and that also covers the underlying cryptocurrencies that were used for certain products. So maybe a year ago you might have ETH and BTC. Now you have many more of the top cryptocurrencies being used in derivatives products.
Interesting. Yeah, there's more diversification among derivative products.
That's for sure.
When we look at the profile of traders, what shift have you seen in terms of profile and sophistication among investors over the past year or so?
Yeah, again, it's difficult to pinpoint an exact change, but if we could, we know that derivatives products tend to be used by more sophisticated traders to hedge risks, given that derivatives volumes have increased, and that also goes for options volume has increased quite significantly, especially on venues such as Deribit. We could then assume that actually there are more sophisticated traders operating in derivatives markets now than there was a year ago.
Interesting change, how quickly the markets change. Let's go to the next slide and let's take a closer look at the derivatives component of your research. Which futures exchange are included in the research from the first perspective?
Yeah, so we include all of the major exchanges in our derivatives research. So that includes Binance, Huobi, OKX, BitMEX, other players such as CME, Deribit, FTX as well. Yeah, and they account for the majority of the volume. So we capture what the market is actually doing from month to month.
When we're now looking at the derivative products, options contracts are becoming increasingly utilized on both regulated and unregulated exchanges. What are you noticing specifically about them?
So specifically, options volume is increasing, especially on venues such as Deribit. CME volumes have been pretty steady in terms of their options volume. I think they peaked in June, so around 8,000 contracts were traded. Now it's sitting at around 4,000 contracts. We're definitely seeing increased open interest for options products. So it's increasingly being used as a tool for more sophisticated traders.
Okay, let's have a look at the next slide. How's open interest looking?
Yeah, I mean, at the moment, OKX is leading in terms of open interest at around $1.5 billion, closely followed by Binance and then Huobi. At the moment, CME and BitMEX are pretty much equal in terms of open interest, with just over 800 million, which is significant given that CME is, one of the only regulated players at the moment.
We've had a wild few weeks with Bitcoin price action and the US elections. What impact have the US elections had on the futures market? What's its volumes versus open interest?
It's hard to say exactly. I mean, we can see that volumes did drop from September to October for derivatives volumes, at least. And that's also the case from August to September. So again, difficult to pinpoint to point to the US elections in this case. There are, of course, other factors going on, such as COVID, the lockdown. Again, we'll see exactly how markets react to the ongoing US election situation in the upcoming months.
Let's have a look at your next slide. And let's look more closely at CME activity. What are we seeing there at the moment?
Yeah, at the moment, CME volumes have actually decreased in October. Yeah, again, in line with a few of the other derivatives exchanges. However, what we did see was that their open interest figures increased by just under 29%. And this might point to increased institutional interest in regulated venues. Again, we'll see if that trend continues into the future months.
Very interesting. I hope to hear more about that trend with you in a month. Constantine, many thanks for joining us and sharing your insights. We look forward to having you back on very soon again.